Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. Well, what can I say? It's been an ugly beginning of the year and the markets have really been extremely volatile. No rhyme or reason, just that it wants to go down. The chart shows how much we've come down since the beginning of the year. I said to you last fall that when this market started to tumble, that we needed to go back and test the 16,000 level on the Dow. We are about that level today. I'm recording this on Thursday, in January, and we hit that right about that 16,000 level, have bounced off about 200 points. Whether that's going to hold, only time will tell. I said to all of you that one of the most important things that I do for you as clients is to try and do everything I can to protect the level of income that you are needing to sustain your lives. And I've expressed on more than one occasion my dissatisfaction with my peers on Wall Street who are telling people to sell and go to the sidelines. They don't seem to really understand that if you've been getting dividends from your stocks and that they're going down, but you sell them and you go to cash, that you're not going to get anything from cash and you're going to have to start selling your assets. I can't do that. I know it's painful. I know I'm experiencing everything you're experiencing. But what's most important to me is that as I believe this will pass. Since the Great Depression, we've had a number of bear markets, corrections, whatever you want to call them. But there is a trend that each one seems to be that they get shorter and shorter and shorter. The second Great Recession, which was 2007, 8, and early 09, took a little over 2 years and recovered, and we had 7 years of a good market after it recovered. I do not see, and make this clear, I do not see a scenario that says this market correction will look anything like the 46% decline of the market in 2007, 8, and 9. I don't see that. I know it's painful, and energy has been a big problem for all of us in our portfolios because it was paying good dividends. Many of the things that we own are swept up into the energy decline, but I don't believe the pipeline companies are going out of business. We're still going to have to transport oil and natural gas from one point to another. We don't own any drillers. Let me make that clear. We own no drillers. We own pipeline companies and we own royalty trusts. However, as demand declines because of oversupply, the revenues that's going to be generated will be diminished, and that will have some impact on dividends. I don't believe that it will eliminate all dividends. And I believe that the dividends, even at a reduced level, will pay a much higher rate than zero on cash. So I know it's a difficult time. I know it makes you frustrated, angry, emotional, but don't make decisions based on emotion. We've got money set aside. We've got cash. Any of my clients who are living off of income, we have a sufficient amount of cash to pay at least 1 year's worth of income or required distributions from your 401k or IRA. So there's no reason to sell because we've got the cash to pay the income that you need. That's very important. One thing that is yet to be talked about, and this is the second time I've mentioned it, and that is with the decline in oil prices, what we may see, since it's now been protracted for over a year, is an opportunity that's going to create more pressure in our economy, and that's called deflation. I'm not sure it's an opportunity. It will be for some, but deflation, we've already seen that impact when we got the import numbers today because of the lower price of energy and the lower amount of energy that we're importing because we're becoming more and more energy independent. Imports have dropped dramatically. We've seen the decline in prices at the pump. However, I don't believe that the recent decline in crude oil is reflected fully in the price of gasoline. I wouldn't be surprised sometime in the next 30 to 45 days that you go to bed one night and it's 160 and you wake up the next morning and it's 142. We've got that kind of a decline coming in. Now, that means a lot to the consumer in less gasoline, money spent on gasoline means more money in their pocket with stagnant wages. And clearly wages have been not only stagnant but gone down over the last 7 years. So at some point in time, we will hit a bottom in crude. I don't know whether it's 30, whether it's 25, 27, 20, I don't know what the number is, but we will hit a bottom. And at that bottom, we'll begin to adjust to a lower oil price. From that point on, they won't go any lower or marginally lower. So we could be at a price point, and stay there for an extended period of time, maybe a year, 2 or 3, before there's any movement. I'm looking for an emergency meeting of OPEC sometime within the first quarter, called primarily by the lesser nations in OPEC, to dramatically cut production. Now, OPEC production right now is about 34 million barrels a day. I suspect that we're going to see a proposal from the lesser nations of a cutback to maybe 25 to 28 million barrels a day. There's a huge glut of oil everywhere in the world, and it's going to take time to work off that inventory. And OPEC is going to realize unless they stop production, they're never going to get out of this spiral. And they're burning all of their cash and all the reserves. They're going to run out of money. So I expect to see that happen sometime before the end of the first quarter. If that happens, I would expect to see U.S. energy stocks explode upwardly. Why? Because in the omnibus bill that Congress and the President brought into law last December, there was a lifting of the 40-year ban on the exportation of crude oil. I think as OPEC decides to cut back production, American oil interests will see that as an opportunity to go in and try and take market share, which will put further pressure on OPEC. I think we have, in the next 12 to 24 months, the ability to destroy OPEC as a cartel and free up the markets to a natural place, as opposed to letting the OPEC nations arbitrarily decide what they want the price of crude oil to be. It is a very difficult time, and I know it's emotional, and you're worried, and you're scared. So am I. But I've been through this in 41 years many, many times. The greatest challenge is to not let your emotions get control of the decision-making process. I guarantee you, I fight with it every day as I watch the markets all the time. The first thing I see when I get up in the morning, and the last thing I see before I go to bed at night. I'm very concerned about what's going on. I'm very concerned about the declines in my clients' portfolios, but I believe longer term we're well positioned, and we have recovered many, many times before. So, it's tough. I know you're frustrated, maybe a little angry at me, angry at the markets, wondering why this happened. I didn't cause the problem. I'm trying to manage through the problem, and I'm trying to keep you as best I can in the income level that you need to sustain your life. As always, if you have questions about what's going on in your account or in the markets, please feel free to give me a call or send me an email. This is Dan Perkins. Keep the faith. Thanks for watching.